It is Monday, September 19th, 2016. This is Ron Feinstein, the Consummate Price Behaviorist at New Wave Forecasting. A little bit of a recap of what transpired in the markets today, and much more importantly, what I think is likely to happen from here. Okay, let's jump right in on the crude oil market. I thought we'd have a run towards 44.25 today. The market actually died at 44.15. After a little bit of further inspection here, I think the most likely scenario is that we're going to start another leg down here towards 41.50. I mean, this really does look a lot like a textbook Elliott wave, with that 44.25 miss at the fourth wave of the extended third. So, it's interesting. I suppose you're going to find some buy interest again near $43, but this looks like we are going to drop again. And, I'm just eyeballing this 41.50 based on this wave channel. But if we're going to get wave equality, this move started at 47.75, took out 45. So we'll call that almost 275, 280 from 44. That's a little closer to 41 and a quarter. So we'll shoot for 41.50 to 41 and a quarter here for the potential terminal wave down here in the crude oil market. The 10-year was a pretty uneventful trade here today. And again, I've been suggesting that it's in some kind of a triangle consolidation pattern, and it's not likely going anywhere in a hurry. We did come down to 130.08 here this evening, or perhaps late this afternoon, which was the 76% retracement I was looking for. I don't know if that's it. There's no spike. Normally this market kind of spikes when it makes a low, and we don't have one yet. So maybe we'll drop below 130.08 before recovering. I like the long side here. I think the risk is pretty well defined at this 130.03 level. And even if it gets taken out, I don't think the market's going to collapse. I just think it's going to just waffle at lower levels. So again, I think this is probably going to turn out to be an opportunity. Let's see if we can take out 130.08 and then start to come back again. I don't know that it's going to roar or anything, but I do think it should, basically what I would argue is the next half a point, if I'm right, has just got to be up. Okay, moving on to nat gas, which had every opportunity in the world to collapse today and did not. This does not change my opinion here, frankly, that it's better to be looking at the short side of the market than the long side, as we are once again banging against this 294 plus danger zone. All I can say is if you've been short above 294, the market paid you. And if you've been long above 294, you had a matter of minutes or hours to get out of the position. In the remote event that the market is actually going to trade higher, we could be looking at a rising wedgie type pattern, and we could conceivably test $3. I think it's really unlikely, but I can never rule it out. So net, I have to view this as a courtesy rally here if we move above 294, and we'll see what happens. I guess we really need to break this trend line at 291, and if we do, then I think we got a quick shot down at 285. Taking a look at the gold market, it did almost nothing today, but I've got to say that I kind of like the look of this move off the low. One might argue that it's a five-wave rally. I'm not prepared to put my rep on that one, but I think the RSI pattern looks somewhat constructive. So again, as I suggested yesterday, I think it's probably better to trade this one from the long side than the short side. And I think, again, looking for a test of this downward resistance line somewhere in the neighborhood of 1327, assuming we can hold it below this 1315. So frankly, as I spend a little more time looking at this, I would probably argue this is the wrong device. I would suggest that this is in fact a danger zone situation on the downside, and 1315 is likely your support area. So got to view this as a courtesy situation and look for a net probably that the next $10 move should be up in gold. So we're looking for a opportunity here, a courtesy dip below 1315 for a play for a $10 rally above 1325 in gold. I thought if the euro currency was in trouble, it was not likely going to trade above 112.20 today. It actually blew through there, although in a big picture scheme of things, 13 to 15 points is not a lot. But this did alter the forecast, well, pretty dramatically. So I don't really know what to say about the euro right here. After it pushed above this early consolidation below 112.15, it's yet to fall below there. If we do crack from here, I think we're going to see 111.50. But 112.50 is clearly the big resistance, and I can only point out again that the market has been inside this range for so long that we are probably looking for trouble by reading too much into these specific patterns at this point in time. So I'd be more interested in support and resistance levels, frankly, than what any delusional wave pattern interpretation might mean right here. Okay, moving on to the equity markets. You know, when it comes to the S&P here, all I can say is if it looks like a triangle and it quacks like a triangle, it's probably a triangle. The S&P, I pointed out real time that when we fell below 2138 that there was a problem. We did make that short-term chart pattern projection, but this market rebounded, failed right at the neckline, so I think we're going lower. Conventional support on this trend line comes pretty close to the 76% retracement, somewhere in the vicinity of 2120, 2118. Doesn't have to go quite that low, but I do think the market is more likely going to break 10 points than rally 10 points from current levels. Big picture, we're still in this consolidation. You know, I mentioned I didn't know if a lot of the options traders would be back or not today, and my guess is they're not. Whether or not that really is important in the big scheme of things, I don't know, but I was watching some of the individual stock action today, and there was some strength in the financials and some other pockets, but by and large, it was just kind of a nothing session. So I think we probably will trade lower in the S&P, but I don't think we're in the about to break down in any way, shape, or form of major significance. All right, going to wrap here with the EMini. You know, I talked about the potential for a bull trap here above 48.25 last night if the market moved higher and failed to hold its gains, and that's pretty much what happened. I don't think this is a really bearish situation. However, the market should trade lower, and I think we are probably going to come down and test this breakout level and perhaps maybe even fall below it. It's hard to say, but I don't think the market's dead by any means. I did point out during the day early on that we had a problem because the NASDAQ was supposed to be stronger than the S&P today, and it was actually weaker. And I think that was the pretty big clue that the markets certainly weren't going to move higher. Although, again, how much dramatically lower they can move, I don't know. But if the NASDAQ were to bounce early tomorrow, I think it would probably be a courtesy rally. As I would look at it here, somewhere in the neighborhood of 48.20 to 28.5, probably a decent sale. For I'd come looking for a test of the breakout level somewhere 47.60. So again, inclination would be to trade both the E-mini NASDAQ and the S&P from the short side tomorrow in the event there was some early strength. Whether or not it's ever safe to chase any of these markets when they break down, that's another question altogether. But it certainly wasn't a good day for equities. So that's my wrap here for the session. Again, this is Ron Feinstein, New Wave Forecasting. Monday, September 19th, 2016. We're back with real-time forecasts tomorrow.